Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at Chargepoint Holdings Incorporated, ticker CHPT. This is one of a few stocks that were requested, and looks like they're all growth stocks, so we're going to see what a decent price to pay for the stock would be and a potential growth rate. Chargepoint is first on our list, and I have a feeling this is going to be a pretty short video because I'm not liking anything that I'm seeing here. They are a company with negative earnings, negative cash flows, a debt to equity of 2.37. They might have some good growth, at least expected going forward. Hasn't been very good for the last 2 years, but even that doesn't put them into a very good place. So we'll get right into this. Earnings yield, negative 16.5%. I think that's one of the worst that we've ever seen, which says that the current price it's tricky because they have negative earnings. I mean, if we take that sign out from in front, 16.47 would be a decent earnings yield. So really we would want to see them flip from negative to positive around the same amount. And we can take a look at those numbers here. This last year came in at negative 1.22. Expected to come in at negative 0.35 this year and negative 0.18 next year. So no profitability in the next few years, potentially in 3 years. And for that reason, I wouldn't really want to touch this stock for at least another 2 years. You can see the variability here. It definitely looks like it's one of those stocks that gets some hype, rides up, and then loses it all, and just continues going through some waves. As high as $10, as low as $121, currently at $135. I'm coming up with a negative fair value. The balance sheet isn't in very good shape. Cash flows are negative, earnings are negative. The company is worthless. They continue to issue shares, diluting the already worthless positions of investors. It's a recipe for disaster here. And if they fall much further, there is a risk of being delisted unless they go through the process of a reverse stock split, which is never a good sign. So, trying to come up with a thesis here. Revenue growth does look pretty decent going forward. They're expecting about 9% growth this next year, 20% over the next 2. So 15 is right there in between that. We'd like to see at least that much. I mean, of course, more would be ideal, but we'll start with a reasonable scenario. Share count, I mean, they haven't gone as low as 5%. In the last year, they issued almost 21%. Their balance sheet has a lot of debt that it probably shouldn't have, and their earnings, they lost money on everything. Assets and investments, both in the negative 40% range. This is the worst that we've seen. Margins, at least they had a positive gross margin. Net margins, they're not making like any money. Not only did they lose money, but they almost spent twice as much as they made. Definitely just a messy situation here. Cash flows, best case scenario here is they hold them flat. That's something where this last year they came in at almost negative 69, and on average they're around negative 67. If they can hold it flat with the current value, they could bring that to negative 34% with the growth in those revenues. So, I mean, that'd be a good situation there. Ideally, they go positive with it, but it's hard to reflect that in the numbers here, and it just doesn't look like it's going to happen based on what we're seeing. Assets, small asset growth, 2 to 8%, 4 to 6 would be what we would want for the thesis here. Liabilities, slowing down in growth, 7% this last year, almost 36 the prior year. So we can definitely bring this down, maybe something more in line with 12. I'd like to see them continue a downtrend in those liabilities, and we'll test that out next. No dividend. Margins, this negative actually makes it more positive because we're starting out with a negative number. So if they can drive their margins in the proper direction by 5% per year, then at the end of the 5-year period, they'd only be losing 70%. All in all, poor management. Don't get sucked into this stock. I don't see it being worth anything for at least the next 3 years. And when you're spending twice as much as you're making, it's definitely possible that you're going to go under. So this would be a risky gamble if you were to invest into it. I would not put a lot of money into it. Personally, I'm not going to put anything into it. It's at such a low point that I wouldn't bet against it either. It's just something that's there on the market. Because what I'm coming up with currently, the fair value is negative 740. As in, you're giving them money and they're just burning it. In 3 years, I'm coming up with negative 720, and in 5 years, negative almost $8. And like I said, this is going to be a quick video because there's not much else to say. This is just a warning that you're investing in this stock probably won't pay out for at least 3 years, potentially more. Usually in the markets, you're not too likely to actually lose your money, but in a situation like this, with the low share price and the atrocious net margins, definitely looks like a company that could potentially go under and you would lose everything. So I want to thank you guys for watching this one. Please like if you enjoyed the video. Comment what other stocks you want me to take a look at and subscribe so you can stay up to date with everything. And I'll catch you next time.